You know, sometimes the sector of the market that does the poorest is often destined to be the future best sector of the market. I'm going to discuss what that means and what I see as a possible hot area of the market over the next few months. Plus, we'll look at the overall markets. I'll give you my assessment of whether this stock market crash is over. And then we'll look at the day trade of the week on TLS. So over the last few months, there's been one sector of the market, one asset class that has done much worse than others. Within the stock market, the small cap stocks have done quite poorly. If we compare the small cap stocks with the tech sector, the large cap sector, we see a much more significant negative performance in those small caps. And the reason is pretty simple. Rising interest rates, as driven by a falling bond market, are most destructive to those small cap stocks. You see, a company like Apple doesn't really have to borrow money. They have lots of cash. But a smaller company is really dependent upon borrowing and what interest rates are doing overall having an effect on their business. And so the result then is that the Russell 2000 index, the IWM is the ETF, has done quite negatively and continues to be underperforming something like the S&P 500. Over the last 7 or 8 days, the S&P 500 has risen quite well, but the small caps has not. And so then the question is, well, when do the small cap stocks start to play catch up? And the answer is probably when the bond market stops going down and starts going up. Now, just a quick lesson on interest rates. If the bond market is falling, that means interest rates are rising. And so although the US Federal Reserve and other central banks around the world have a big impact on what interest rates are, it's ultimately driven by the bond market. The bond market will tend to predict what the Fed and other central banks will do before they actually do it. And so when the Fed says something like, well, we think that interest rates could be higher for longer, they haven't raised interest rates, but that cautionary note will cause the bond market to fall and interest rates in the treasury bond market, in the overall bond market to rise. All right, so that's what's driven interest rates, and we've seen that significant rise in rates over the last, year and a half, but certainly in the last 2 or 3 months since the start of August, we've seen that happen. And that's caused those small cap stocks to fall. But what we've seen in the last week and a half, is the bond market has stopped going down, and it did so from a parabolic downward trend. So I'm going to show you what this looks like because it's much easier to see it visually. All right, so here is a chart of TLT, which is the bond market ETF. And you can see that it has been falling since April, but the more significant part of the fall was in here through August, September, October. And notice that the steepness of the fall got steeper and steeper. All right, so we call that a parabolic downward trend because it's curving down and away. When you get a parabolic trend, what that really tells us, then investors are getting emotional. And in the case of a downward trend, it's really fear is taking a dominant force. And you can see the rise in volume through that. So there's been a little bit of a panic in the bond market, which has meant interest rates have gone sharply higher. Now notice what's happened in the last week to 2 weeks. We saw this parabolic downward trend get broken at the start of November, and we made a significant jump. And this is typically the sign of a bottom in the bond market. And if we think that higher rising interest rates have been the primary reason for small cap stocks to have underperformed, then we could argue that the small cap stocks should now play catch up. All right, now let's take a look at the chart of the the IWM, and you see something similar. Here is the downward trend, and notice that it got steeper and steeper, and it recently broke that parabolic downward trend. And then we had a little pop for 3 days. We pulled back. And then on Friday, we hit a new low in the morning, but we managed to close above the open And in doing so, we set up what I call a rising bottom. All right, so this bottom is higher than this one. And now if this market can break the downward trend, it should play catch up. And those small cap stocks, and generally lower price stocks, which have done quite poorly in the last few months, should start to perform better. And so when I do market scans and looking for opportunities on Stockscores, so often it's the small cap stocks that really look the ugliest. But one thing I've learned over the years is that today's ugly is tomorrow's darling, and it happens over and over again. Money moves completely out of something, and then there's bargains there, and then money starts to come back, and it becomes the upward momentum of the future. So watch carefully the bond market. All right, let's get into the analysis for this week. Here is our first chart, the S&P 500. Let's take a look at a 1 month, 60-minute chart. And you can see that we've had a pretty good little rally in the large cap stocks over the past few weeks. We broke the downward trend line, we built a rising bottom, and then we broke up from a rising bottom. And again, this is a short-term chart, so it's been that short-term rally in those large cap stocks. And they finished the week with a nice little run to the upside. If we look at the 3-year weekly chart, we see that this rise over the last 2 weeks has essentially brought price up to the downward trend line. And so here was the upward trend line. Notice I start here at the low, and then I cut across this, what we call an inflection point, and price fell into that support at the trend line, bounced off of it. I expect we may see those large cap stocks pull back a little bit and then try to break that downward trend line over the next few weeks. So stocks looking better, still not really out of the woods because we haven't broken that downward trend line yet, but definitely looking better than, say, 2 weeks ago. Now here is the tech stocks, and again, a lot of these companies really have no concern about interest rates in terms of their borrowing costs, although certainly it impacts the spending patterns of consumers. But you can see that the NASDAQ 100, the tech stock index, has broken its downward trend line. And so unlike the S&P 500, which is still kind of pressing up against it, we can see that it's broken. Now, if we go to the 3-year weekly, look at the difference between this and the S&P chart that we just looked at. This has actually broken the downward trend line. It'll probably rise up to there and then get stuck, but in the short term, that's just a short-term concern. But ultimately, it should make its way back to the old highs. So that's how the the tech stocks are shaping up. Now let's take a look at those small caps, IWM, and we'll look at the 3-year weekly here. See how this is much more underperforming than those other sectors. So compared to the large caps, compared to the tech stocks, this is still in a downward trend. It has no rising bottom, and it still needs to break this downward trend line. Now it has held this support zone well, which is what we would expect to happen. And given that the bond market is starting to turn, and we'll look at the bond market chart in just a minute, this may be the sector that's going to play catch up and give us some of our best opportunities as people buy bargains in that group. All right, what about Canadian market? T.XIU is the symbol. Let's take a look at the 1 month chart first. And we can see some decent gains. Kind of sideways the last week, but looking better. I wouldn't say it's a great looking chart yet. On this 3-year weekly chart, we see that it's been stuck in this sideways range for a long time, and it kind of fell out of this more narrow range that's been underway for almost a year and has moved back into it. So it's kind of a neutral looking chart. It's really just stuck in this sideways range. Certain areas of this market are doing well. Some of the commodity-based sectors are doing better than, say, the banking sectors, that sort of thing. All right, well, let's look at commodities now. GLD has had quite a bit of volatility in the last month, and in the last week, it's actually sold off. You can see here the weakness in gold, and I wasn't that surprised given how quickly it ran up. When markets run up quickly, they inevitably get some profit taking. So what do you want to watch for in gold stocks now is if this downward trend line gets broken after the build of a rising bottom. If it were to come down into here and then break, then it'll try for its next leg up. For now, I think you want to sort of stay clear of the gold stocks, because looking at this short-term chart, you can see that first the upward trend was broken, then a falling top formed, and then we broke down from a falling top, and that's led to weakness. It's a very common pattern, very simple to look for if you know that sort of cycle. All right, let's take a look at oil stocks. USO is an ETF for oil. We'll look at the 1 month, 60-minute chart. And you can see that the tops are falling from left to right. So the sellers are in control. We're in a downward trend. Got a little oversold, coming back up to the trend line. But until we break the trend line from a rising bottom, this is a negative chart. So US or oil in general in the short term is fairly negative. Now in the longer term, it's not terrible, but we do have an upward trend line that was broken from that falling top. I think oil may come back into this trading range right here. So we got a little more downside until it's going to be able to find some support. All right, well, how about the US dollar? Here's UUP, and you can see that the US dollar, which has really performed well through here, has been in this sideways pattern for about 6 weeks. And now starting to test those lows, maybe building a falling top, we could see this break down. Let me tell you why in just a moment. I'll come to the bond market chart and you'll start to get a sense of why. But before we do that, let's take a look at the Bitcoin chart because it has been one of the hot sectors of the market. And I've been bullish on Bitcoin for a while after being bearish for many, many months. But when Bitcoin broke out here from a rising bottom, it started this upward move. It is too late to be a buyer. If you're going to be a buyer of Bitcoin, you have to wait for a pullback and then a break of a pullback. Because chasing a market that runs up like this is not the ideal way to trade it. Now, maybe you can day or swing trade some of the stocks in the group, but Bitcoin itself has already made its breakout. It's getting risky up here. Looking at the 3-year weekly chart, I think it still has lots of upside, but it needs to make a little bit of a pullback because here's your trend line. Simple rule. When price runs away from the trend line, it's going to come back to it. You see it happen over and over again. Runs up, pulls back, runs up, pulls back. Now it's run up, it should pull back, and then likely continue higher. So in the short term, risky, but still the trend is up. All right, now let's take a look at the bond market. So I talked about this at the top of the video. There's your parabolic downward trend. You've broken that. So we've started the bottoming process in the bond market. And that is going to help all stocks, but particularly small cap stocks. That is also a reason why the US dollar may weaken. Because when the bond market is going down, interest rates are going up and people want to buy those bonds to get the yield on the bonds. And if the bond market starts to go up, then interest rates are going to go down, making the bond market less desirable, which can cause the US dollar to fall back. All right, so not really breaking any downward trends yet. It's just trying to bottom. There's still work to be done. We still need to build a rising bottom, break that downward trend line. Then, and only then, can we really get bullish on the bond market, negative on interest rates. In other words, interest rates likely to go lower, and that should help those small cap stocks. All right, well, let's jump into my ratings then. Change the ratings a little bit this week. US large cap and NASDAQ stocks, short-term bullish, but long-term neutral. But the small cap stocks still underperforming, neutral in the short term, bearish in the long term. Canadian stocks neutral on both time frames. Gold, oil, and the US dollar, gold and oil bearish in the short term, neutral in the long term. US dollar is neutral. I didn't color code that correctly. So that's neutral US dollar in the short term, neutral in the long term, although you could see this get a little bit more bearish in the US dollar in the short term. Bitcoin bullish on both time frames, but a little overbought, so don't be surprised if there's a pullback. And then interest rates neutral on both time frames. All right, well, let's get into this week's day trade of the week. And this is an example of the kind of stocks that we trade in the Stockscores active live service, where you can watch my analysis screen as it runs through the entire market, looking for opportunities. One of the key things we look for are stocks that are trading abnormally, and then make what we call an action candle, which is a 1-minute bar that has abnormal price and abnormal volume. And provided that action candle comes out of a predictive pattern, we have a buy situation. So this stock on screen now is TLS, and it gave us a swing signal early in the day. So in the opening part of the day when it made this rally higher here, it sort of caught my attention. So we put it on our watch list. And then it built an ascending triangle pattern. So those of you that follow technical analysis will have heard of that before. It's a pretty common thing. And there's the action candle. You can see the little yellow dot right there breaking out of this pattern. And it's a yellow dot, an action candle, because the price action was abnormal and the volume traded on that 1 minute bar was abnormal. In other words, there was a crowd coming into the stock all of a sudden. And we follow that. We see these early buyers, we jump on with them, and then we carry the upward trend. And of course, the general public is buying late and we sell into that strength. So here was a nice move. This particular trade went up about 7 times risk. And so that means if you risked $100, the profit was $700. And if you risked $1,000, and the profit was $7,000. You get the idea there. So that's a pretty good day trade on a relatively slow Friday trading, but certainly this one did quite nicely. Hope you've enjoyed this week's Market Minutes video. If so, click on the like button, subscribe to the channel, but most importantly, trade well.